Hello, everyone, and thank you for joining us today for the second OIC webinar in July, where we are going to talk a little more about complex option spreads. Today, we're going to dig into the condor and the butterfly a little bit more deeply. I will talk again about the vertical spreads that are the component pieces of these complex option spreads. But we're going to take a slightly different tack today, and instead of discussing the iron condors and butterflies from last week, we're going to talk about the call condor, the butterfly, and we're going to touch a little bit on the broken wing butterfly at the end of the presentation. So hopefully, along with the first iteration of the complex spread webinar that you watched last week, this one will serve to build and round out your knowledge base and give you some confidence about how these complex spreads work generally so that you can use them when they align with your investment goals. My name is Matt Cashman. I am the Principal of Investor Education at OCC, as well as an Options Industry Council instructor. Just to give you a little bit of quick background on myself, I started trading around 1998, and I've been an options trader ever since. I got my start in Chicago on the floor of the CBOE, trading equity and index options. Quickly after that, I moved to London and traded interest rate options there for about 3 years. And then eventually I moved back stateside, where I started and ran an index options market making operation for the better part of about a decade in Chicago. Currently, I work at OCC, helping individuals and investors to better understand both the risks and the benefits of exchange traded options through efforts like the webinar that we are all a part of today. Now, we always include the wonderful disclaimer to make our lawyers at OCC happy. Options are complex investment strategies. They involve risk. They're not suitable for everyone. Any strategy that I discuss, including examples using actual securities price data, are strictly for illustrative and educational purposes. Please do not construe them as an endorsement, recommendation, or solicitation to buy or sell securities. Past performance is, as always, not indicative or a guarantee of future results. One other bit of housekeeping: the following trademarks, logos, and service marks displayed are owned wholly by the Options Clearing Corporation, and you will see them used throughout the presentation today. Now, a little bit about OIC. The Options Industry Council is the educational arm of our parent company, the Options Clearing Corporation, or OCC. You'll see that right here. OCC is our parent company, and OIC is the Options Industry Council, where I work. The OCC is the largest clearing corporation of equity and exchange traded options in the world. OIC started out as a collective in 1992 to better educate the public as to the risks and benefits of exchange traded options. Currently, we continue to pursue that goal mainly through the utilization of our website, which you'll see right here, optionseducation.org. There you will find online courses, podcasts, videos, webinars like the one you're listening to now. We are able to provide these services free of charge to the public because we are fully funded by our parent company, the OCC. Now, I encourage people to really check out all of the educational material at optionseducation.org. It's a fantastic resource, and it's a place where we are continually updating and expanding our educational outreach. So if you're at the beginning of your options trading adventure, or if you're in the middle, or if you've been trading for 10 years or longer, there's going to be something that you'll be able to find there, I guarantee, that'll help round out some of your blind spots as far as knowledge base and options and optionality and how options work. Make sure you check it out. The other thing that is wonderful is about this email address right here, which I'll get to in a second. I work on a fantastic team at the OIC, the Investor Services Desk, or the Investor Education Desk. I sit there with 3 other colleagues, 2 of which are actually answering your questions via the chat today during our presentation. Make sure to say hello to both Ken and Roma. They are going to answer your questions as you ask them, and please be patient. Oftentimes, lots of questions can come in at the same time. They're going to do their best to get you an answer as the webinar is happening. But if you don't get an answer to your questions today, you can always send us email questions at this email address right here, options@theocc.com. This, again, is a free service that we extend to the public as well. It's important to note we are not registered investment advisors, so we cannot direct you on trades. We can't suggest investment strategies, but what we can help with are general questions about options, optionality, theoretical knowledge surrounding the options ecosystem. Amongst the four of us that sit on the investor education desk at OIC, we have over 100 years of collective industry experience surrounding options, either on the brokerage side, the trading side, the risk side, the market making side. We've got all of those bases covered, and we are always happy to help in whatever way we can to further advance your understanding of options and how to responsibly use them in your everyday investing. It's what we do, it's what we love to do, and we love to really leverage all of that experience to help round out your knowledge base. With that said, let's dive right in. This is the slide that I always use at the beginning. Most of us actually use this slide at the beginning of our presentations. The reason why, it's annual options volume from 2000 to 2022. And this shows you exactly what we're dealing with as far as options volume are concerned in the marketplace. When I started trading, which was right before this era around here, we were talking about less than 1 billion contracts of OCC cleared volume during an entire year. To put that in perspective, we are north of 10 billion contracts for 2022, and the numbers for 2023 are looking like it's going to be even greater than this number, and maybe close to 10.5 billion contracts. It's an incredibly amazing feat that all of these contracts get cleared in the way that they do. It is also evidence that there are a lot more people involved in the options industry trading right now than there were in 2000. Over the last 20 years, the industry has exploded in options volume. Obviously, much of that volume has come in these last 3 years between like 2020 and 2022. Now, many people will, lots of words have been written about what caused all of this options volume, and lots of people can debate about where it all came from, but the result is the options volume is there. And from my perspective and our perspective at OIC, from an educator's seat, it means that what we do in the education space is much more vital now than it ever has been before. We want to make sure that you understand the math that belies these contracts, the actual leverage that is inherent in them, and that you understand what these options can do and what they can't do before you walk in to an options marketplace and start pressing buttons on your mouse and buying and selling options without understanding the limitations of their risk. So make sure that you understand what you're doing before you get in there and trade. But hopefully what we're going to talk about today is going to help build out that knowledge base a little bit as we go. So let's get right into it. Today's presentation, we're going to, again, talk about vertical spreads. They are the building blocks of these complex strategies. Last week, we talked about the iron condor and the iron butterfly. Those complex spreads utilize these vertical spreads much in the same way that the spreads we're going to talk about today. These complex spreads use the same vertical spreads, but they're a little bit different. And I'll get to that as we get into it. But it's really important that we understand how the actual spreads themselves work first, and then we put them together to make sure that we understand how the full complex spread works. So we're going to talk about the call credit spread, the call debit spread, which we basically just stack on top of each other in order to create this call condor. Then we're going to get into what the condor actually looks like. And we're going to talk about the condor versus the butterfly. And at the very end, we are going to touch on what some people would designate as a slightly more complex or exotic complex spread, the broken wing butterfly, and why its risk dynamic is slightly different than any of the other dynamics that you're going to see out there. You'll see how that looks from a P&L perspective when we look at the actual P&L graphs for all of these complex spreads up against each other, and we'll be able to look at how those dynamics work independently and collectively amongst the three of them. Hopefully at the end, we'll have a little bit of time for Q&A. Let's dig right in to spreads. Again, we're going to start at the beginning. These spreads are really the building blocks of the more complex option strategies. It's vitally important that you understand the risk dynamics that exist within these basic spreads, and that you and that you're able to really master them before you start using them to build these more complex strategies. So a spread involves two or more positions. Obviously, it's a buy or a sell. A buy or a sell of one option, and then a corresponding buy or a sell of another option. Generally speaking, we're going to use the same underlying most of the time. It's likely the same expiration date. You're trading these options within the same month many times, and likely they are going to be using different strike prices for these spreads. Now, you don't always use different strike prices. I can think of one example where a spread itself might not have two different strikes. That would be a straddle. A straddle is actually buying a call and buying a put on the same strike. So you're not using different strikes there, but I would say that's an exception that proves the rule that generally when you're trading a spread, you're going to be using different strike prices, possibly different quantities. You'll see how that kind of factors into the way that we talk about the butterfly at the end, because that changes how that P&L graph looks relative to the condor. And that's because of the fact that the butterfly has a different quantity on the inside strike. Spreads can also involve a stock position. One spread that involves a stock position I can come up with right off the top of my head is the buy right. Many times the buy right is actually quoted as one price. A buy right, for those that are not initiated into that, it is a long underlying position combined with a short out of the money call against it. Many times people will trade buy rights as one single price, and it can be quoted as one single price. But oftentimes people will trade into buy rights by using their already existing long stock position and then selling calls against that position. That obviously would not be considered a spread that you are trading outright as a spread. You are kind of like legging into a spread, but that would be an example of a spread that might involve a stock position. So for this reason, we're going to spend a little bit more time digging really deeply into the dynamics of these spreads, and we're going to use them to build these complex strategies. Let's start at the bottom and work our way up. Let's talk about vertical spreads. You are buying one option and selling another option. That's basically the dynamic of a spread itself, but we're going to talk about verticals. They use the same underlying and expiration generally. They have different strike prices, and they have what we coin as defined risk and reward characteristics. Now, why do they have defined risk and reward characteristics? The reason why is because you are buying and selling one option against another. That's where the defined part of this risk comes from. In essence, what you're doing is using one option trade to balance the other option trade. And as long as those option trades are in balance in whichever way you would like them to be, then that trade in and of itself represents the way that you want to manage the risk. When it gets out of balance is when generally either underlyings move or implied volatilities move or skews move. Something moves. One of the things underneath the spread moves underneath your feet, and you'll need to look at it in a slightly different way. But we'll talk about that as we go on. Defined risk comes from the fact that you're actually buying one option and you're selling another option against it. That's the beauty of vertical spreads. Now, there's two main big types of vertical spreads. What are they? They are debit spreads and credit spreads. For many of you that trade these spreads, this is not necessarily new information, but it's important to talk about it really within the context of our discussion today, because the call condor is built out of both a debit spread and a credit spread stacked on top of each other. What's the difference for those uninitiated between a debit spread and a credit spread? Well, it's pretty easy. The debit spread, you're going to pay premium to initiate the position, and the credit spread, you're going to receive the premium to initiate the position. Generally speaking, when you're trading a debit spread and you're paying premium to initiate the position, that means that the option you're buying costs more than the option you're selling against it. It's pretty simple. When you're dealing with out-of-the-money options and options spreads, that means generally if you're trading a debit spread, you're going to be probably buying the closer to at-the-money option and selling the one that's farther away. Now, credit spreads are different than that. You are receiving the premium to initiate the position. So the exact opposite is true. The option that you're selling is going to be more expensive than the option that you're buying against it. Thus, The difference between those in price terms is the amount that you are going to be receiving as far as the credit spread is concerned. One important thing to note here, debit spreads and credit spreads, just like any option that you trade, when you trade a debit spread, the actual amount that you pay for the debit spread comes out of your account and it is gone. It's not coming back unless the option that you traded changes the dynamic between now and the time that it expires, where you're actually able to either exercise that option or create through exercise an underlying position that's going to change the P&L of that spread. When you sell something, when you sell an option or you sell a credit spread, the actual amount of credit that you receive into your account stays in your account after you trade it. What changes as far as the P&L is concerned is the exercise and assignment dynamic, that when you get closer to expiration, or if the underlying moves and you're able to either create or need to actually deliver a stock that has moved past one of the spreads and has changed that dynamic significantly from a P&L perspective. One important thing to keep in mind here, when you buy options, you are buying the right to actually exercise that option and turn it into an underlying position. When you sell options, you are incurring the obligation to deliver the actual stock or the underlying to someone else at the strike price on or before the expiration. So keep that in mind when we're talking about debit and credit spreads. We'll get into that a little bit later as we talk about the in-the-money call spreads that we're going to use to build the call condor. Now, we've examined both the simple spread definition, and then we moved on to these two different types of vertical spreads that we're going to need to build this complex trade. Let's dig into the first building block, the call debit spread. Here's an example of the call debit spread. So stock's trading 88.5. We've got 28 days to expiration. You're going to buy the 28-day 80 call and sell the 85 call. Notice the difference in prices here. That is what creates your net debit of $3.55. But I also want you to take into account where these strikes are relative to where the stock is. This is a call debit spread, and it's not a call debit spread because of where the stock is. It's a call debit spread because you're buying it. But what you need to think about is both of these strikes are below where the stock is trading. And because they're calls and they are below where the stock is trading, that means both of these calls are in the money calls. What we are using here is the in-the-money call spread as the debit spread part of our spread to begin to build our call condor, our long call condor. And what you have here is the 80-85 call spread with the stock trading 88.5 for $3.55. If you were to actually execute both of these trades, buying the 80 call, selling the 85 call, and then write it down on a piece of paper and slide it across the table to me, as your risk manager, I would look at it and I would say, okay, great. You are long the 80-85 call spread. That's essentially how we talk about it in options nomenclature. You're long the 80-85 call spread. This is, generally speaking, a neutral or a bullish call spread. The reason why is because this call spread is likely to have long delta if you are going to buy it on a one-to-one basis, which means that as the stock goes up, it has positive correlation in valuation relative to the stock price. So as the stock goes up, theoretically, this call spread should move up in value by its delta. As the stock goes down, theoretically, the call spread should move down in value based on its delta. Now, again, I want you to pay close attention to the strikes here. Those of you that were on our previous webinar last week are going to notice some similarities here. We are using the same strikes. However, we are using the in-the-money call spread as the first building block of this because we're not talking about iron condors here. Iron condors use out-of-the-money options, meaning the out-of-the-money put spread, the out-of-the-money call spread. This call condor that we're creating is going to start with the in-the-money call spread. Now, if you're paying really close attention, you are going to notice when we get to the P&L graphs of these iron condors, or as we get to the P&L graphs of these condors, that they're going to look an awful lot like the iron condor P&L graph from last week. And that's because they are almost identical once you get to expiration. The one thing that you need to pay close attention to, and that I discussed at the beginning of this, is that if you're dealing with American style options and you're trading in the money calls as part of your call condor, you need to pay close attention to the potential of early exercise. As you get closer to expiration, you could be in a situation where someone who is long that call that you are short, if it is in the money, might want to actually exercise that call. You need to be on top of the reasons why someone may do that. That may be just the factor of getting closer to expiration and the actual commensurate put as part of put call parity is worth less and less and less. But a lot of times what you'll end up with is a corporate action or something that's going to alter the actual value of that call in some way, shape, or form. Keep in mind, corporate actions like dividends, if you own the call, you don't have the right to the dividend. The only way to get the dividend in that situation is to actually exercise your call and convert it into a long stock position. Stockholders have the right to the dividend. Option holders do not have the right to the dividend. So that may be a dynamic that you need to pay close attention to when we're dealing with in the money options, particularly American style options. American style options are the only options that have early exercise capabilities. Now that we've established some of the risk dynamics of this in the money call spread and this in the money debit call spread, let's build its expiration P&L graph from the ground up, okay? In this next slide. Again, we're talking about the 80-85 call spread. The 80 call trading 965, the 85 call trading 610. Your net debit is 355. You're buying the lower strike and selling the higher strike. So your max profit in this case is going to be the difference between those two strikes, 80 and 85. Difference is $5 minus what you've paid for it already. So $5 minus 355 is going to give you a max profit of $1.45. And your max loss is always what you paid for the spread. If all you have in your position is just the long call spread and you don't have any stock against it, you don't have any other calls against it, you don't have any puts against it, the most that you can lose is what you paid for the spread. Now, the interesting part comes when you talk about what happens between 80 and 85. Well, because you paid $3.55 for this, your break even is $83.55 or $3.55 above the lower of the two strikes. So that's how the dynamic of this works as far as the call debit spread. This is the first leg of that call condor, and I want you to kind of look at this and really burn it into your memory, because what we're going to do now is we're going to add another spread on top of it. The call credit spread is the spread that we're going to add on top of this in order to create the call condor. Same setup. Stocks trading 88.5. You've got 28 days to expiration. Pay close attention to what we're doing here. These are different strikes. The 90 and the 95 calls are involved in this actual call credit spread. Again, this is a credit spread not because of the strikes or where it is relative to the stock trading. It's a call credit spread because you're selling this spread, and the option you're selling is worth more than the option you're buying. So you're actually going to take in a net credit of $1.70 on the 90-95 call spread. These are your individual prices, $3.50 and $1.80. Again, if you were to execute both of these trades, selling the 28-day 90 call and buying the 28-day 95 call, write it down on a piece of paper, slide it across the table to me. I'm going to look at it and say, great, you're short the 90-95 call spread. That's how we're going to talk about this in risk language. You're short the 90-95 call spread. This, again, is a neutral or a bearish call spread for the exact opposite reason that the 80-85 call spread that we just talked about was a neutral or bullish call spread. This actually has short delta to it because the delta of this 90 call is more than the delta of the 95 call, and you're selling this call and you're buying this call. So because it has bearish qualities, because it has a negative delta, the actual price of this spread should theoretically go down in value as the stock goes down and up in value as the stock goes up. It is going to be positively correlated to stock price as well. Now, the best part about this is it has defined risk, just like the other spread had defined risk. Let's take a look at what it looks like a little bit more closely. You're selling that lower strike call and you're buying the higher strike call. That's different than the 80-85 we just talked about. This is the 90-95, the call credit spread example that we're going to stack on top to create that call condor. Again, these are your prices. The 90 call is trading $3.50. The 95 call is trading $1.80. Your net credit that you get to take in when you sell this spread is $1.70. Let's build it from the ground up. Again, max profit when you sell this defined spread is what you took in as a credit when you sold it. So your max profit below 90 is going to be $1.70. Again, that corresponds to the net credit that you took in when you sold it. Now, what's the most this spread can be worth? It's this exact same that the most that other spread could be worth, which is the distance between the strikes. The distance between the strikes is $5, and if it goes all the way up past your 95 strike, this spread is likely going to be worth its max amount, which is $5. However, remember, when you trade credit spreads or when you sell options in general, the amount that you sell these options for stays in your account. And so what you're dealing with is your max loss is the amount of the max that the spread can be worth minus what you've taken in. Again, the spread can be worth the difference between the two strikes, which is $5. Subtract that $1.70 from the $5, and your max loss is $3.30. Now, again, these parts of the graph are really easy, right? Below 90, the spread probably goes out worthless, and your max profit is $1.70. Above 95, your max loss is $3.30 because both of those options are in the money, and likely that spread is worth $5. However, in the middle, that's when things get interesting. Your break even here, again, 91.70. Why? Because this net credit of $1.70 is added to that lower strike of 91.70. Anytime you go above 91.70 at expiration, that's when this call spread starts to be worth a little bit more, probably, than what you sold it for. And once you get up to 95, you know that this call spread is probably going to be worth a lot more than what you sold it for at $1.70, especially at expiration. It's going to be tending towards its actual parity or intrinsic value, which is when the actual stock trades through that upside strike and both of those calls go in the money. So now that we've looked at both the call debit spread, remember the 80-85, and begin to look at this call credit spread that we're going to stack on top of it, the 90-95, let's put them together and look at how those two risk dynamics really dovetail together and what they create from a complex spread P&L. The typical option condor is the buy of the call debit spread. Remember 80-85, what we just talked about, and the sale of the call credit spread, the 90-95 that we just talked about. The same underlying, the same expiration month, one spread in the money, right? Our 80-85 call spread is in the money, and one spread out of the money. The 90-95 call spread is out of the money. Remember the stock that we have, this theoretical XYZ stock, is trading 88.5. That puts us right about here as far as these two P&L graphs are concerned. So let's talk about the Condor example and put those two spreads together. Again, 88.5 with 28 days to expiration. This trade is really built around the idea that you have a relatively range-bound expectation as far as the stock is concerned, from 85 to 90, and that's how you end up kind of choosing those strikes as to where you think that stock might be over the next 28 days. Again, we're buying that 80-85 call spread for $3.55. Remember what that looks like. Remember what that P&L looks like. And selling the 90-95 call spread at $1.70. Try to recall what that one looks like. That's the one we just talked about. And we're going to put these two together. Your total net debit for the actual complex long condor that we're talking about is $1.85. That's how much you are actually going to debit your account to put on all four of these options. And what does this look like from a P&L perspective? It looks like the call spread that we talked about at the beginning, which is this part, and the call spread that we talked about just before that, which is this part, and you just stick them both together. And what you end up with is this area under the curve or under the P&L curve where this trade is theoretically going to be profitable at expiration if you traded it for these prices. And that's what gives you your break evens. 81.85 to the downside and 93.15 to the upside. Where do those come from? Well, you might see that $1.85 happens to be in there. $1.85 is the net debit for the entire spread. And so what you're going to do is you're going to add it to the bottom strike and subtract it from the top strike. And that's where you're going to get these full break evens for the entire spread. Now let's take a look at it a little bit. This is now, again, this is a typical call condor. The one thing I want to really drive home is the difference between what we talked about last week of the iron condor and this, which is a typical call condor. Iron condors, again, iron condors and iron butterflies use out of the money or at the money spreads. This call condor is using an in the money call spread as the bottom side of it and stacking on top of it an out of the money call spread to create essentially the same P&L graph at expiration, which is really quite interesting. And the reason why is because put call parity and the forces of put call parity keep those puts and calls in line, generally speaking, when we get to expiration, so that trading puts and trading calls is kind of the same thing. They have obviously different risk exposures, but you can turn one into the other by doing different things with stock or different things with other options against it. If you have questions about put call parity or what I just talked about, please make sure to send us an email. We would be happy to talk to you about put call parity. It's a really interesting part of why these call condor P&L graphs and the iron condor P&L graphs look very, very similar to each other, because essentially they are the same position, with the exception of the early exercise American style option in the money call option that I talked about earlier before. So let's talk about this P&L a little bit closer for this. Again, 355 on the lower call spread, 170 on the upper call spread. Your net debit for the whole spread is 185. That's how much you can lose for the entire spread, is 185. And the most you can make is $3.15, which is the difference between one of these call spreads and their strikes. So the 80-85 call spread could be worth $5. The 90-95 call spread could be worth $5. But they can't both be worth $5 at the same time. So what you end up with is being long one and short the other gets you into this risk dynamic that you're going to actually pay $1.85 for the entire complex spread, and the max you can make is $3.15 if one of those spreads, the one that you're long, were to go out worth $5, and the other one that you sold obviously for $1.70 would offset the amount there, and you would end up with a $3.15 P&L winner in that case. Now, this is going to show you those break evens again. $1.85 is the net debit for the entire complex strategy. You add that to that bottom strike and you subtract it to the top from this top strike, and that gets you 81.85 and 93.15 for your break evens on this call condor. Next up, let's talk about the call condor and the butterfly, and we're gonna talk a little bit about how they where they're similar and where they are different, because there's a lot of people have a lot of questions about those two spreads and how they actually interact with each other. So the condor versus the butterfly. This is the condor that we just put together, the 80-85 call spread, sell the 90-95 call spread. And this is really what that P&L graph looks like at expiration. Again, you're dealing with the 80-85 call spread, this in the money call spread, which brings up this part of the P&L graph, and the 90-95, which brings up this part. These are two call spreads that you just cram together to create this. Now, for a moment, I want you to think about what would happen if you were to take out the distance between the 85s and the 90s. if we were just to erase this line and bring these two diagonal lines together, you're going to end up with what a butterfly P&L at expiration looks like. Let me show you the difference. The butterfly, in this case, we would buy, for instance, the 85-90 call spread, and then against that, we would sell the 90-95 call spread. Take a look at the difference here. The 90s are involved in both of these spreads. Now, at the beginning of this, I talked about how you could do things in different ratios with different numbers of options. If you think about what you're doing here, you're buying the 85s, selling the 90s, then selling the 90s and buying the 95s, you're going to end up with one of the 85s long, short one of the 90s here, but then you're also going to have short one of the 90s and then long one of the 95s. So you end up with two on the same strike, and generally the same way. You're going to be short them because buying the 85-90 call spread means you're selling the 90s, but also selling the 90-95 call spread means, guess what? You're selling the 90s. So how does this look from a P&L perspective? It looks very similar, with the exception that you've removed this distance between the 85s and the 90s, and you've created something that generally is going to yield a little bit more premium around this strike, but it's also going to give you a little bit less cushion back and forth as far as the movement is concerned. Let's look at what this looks like in an example a little bit more closely. Again, we're going to use 88.5 as the stock and 28 days to expiration. I think it makes it a little bit easier just to use that as the basis for all of these. Expected price range, again, 85 to 95. This is generally speaking a range-bound strategy that people employ when they think stocks are range-bound. Buying the 85-90, selling the 90-95. These are your two prices, 260 and 170. So your net debit for this entire butterfly is 90 cents. Now, this is a typical butterfly, and what does the P&L of it look like at expiration? It looks a lot like this. Let's dig a little bit into what it actually looks like when we're talking about a close-up P&L. Again, the 85-90 call spread for 260, the 90-95 call spread. You are selling this one, you're buying this one. So you're going to end up with a 90-cent debit for the entire spread. And this is what it looks like at expiration. Now, let's talk about this in component pieces, because what we're dealing with here is a slightly shifted P&L graph, because the stock is 88.5. And remember, when we talked about the Condor, we were talking about the 80-85 call spread, which got you up to here, and then it leveled off until we got to the 90-95 call spread, and then it came down a little bit. That spread exists in that risk dynamic because of the differences between these 85s and 90s. What you've done is you've removed that difference by trading the 90s in both of these spreads, and you've doubled the actual count of options on the 90 strike. So you're long one of the 85s, you're short two of the 90s, and you're long one of the 95s. That is a very typical butterfly strategy and what they look like almost all the time. You'll see them 1, 2, 1 when you look at the actual strikes and how many you have on each strike. Long one, short two, long one. That's your typical butterfly. And what does it look like from a P&L perspective? Much of this is very similar to what a Condor looks like as far as the dynamics of risk. Your max loss, again, because you're flat options throughout this, if you were to net out all of your options, even though you have two of the 90s and one of the 85s and one of the 95s, when you net all of these strikes out, you end up with flat options, which is what gives you, again, that defined risk. When you have a balanced options position, that gives you defined risk. It gives you your long options in places where you need to create some leverage for the short options that you have in this area. But what that means from a risk dynamic is, because you have defined risk, your max loss is what you paid for the spread still. So you paid 90 cents for this. Your max loss is 90 cents up to 85. Your max profit is $4.10. Where does that come from? Well, again, we're talking about the difference in these strikes and how much each one of these spreads can theoretically be worth. If you're at trading 90, this 85-90 call spread is most likely at expiration going to be worth $5. And what's the 90-95 call spread going to be worth? Theoretically, it's going to be worth 0. And so what you've done is created a complex strategy that you paid 90 cents for that's actually going to be trading very close to $5 probably. That's where your max profit of 410 comes from. Remember, when you're trading these complex option strategies, many times what you want to look for as far as the risk headline is, where is the spread that I'm long going to be worth the most when the spread that I'm short going to be worth the least that it can be worth? And that is what is going to create your max profit potential. In this case, you're long the 85-90 call spread and you're short the 90-95 call spread. Where can the one you're long be worth the most and the one you're short be worth the least? That's at 90. And that's why this P&L graph looks like this. Now, keep in mind, the current share price is 88.5. So this butterfly is going to have a little bit of delta to it because it's not the fully at the money butterfly. A fully at the money butterfly would involve, with the stock trading 88.5, an 88.5 strike as the centered strike. But in this case, because the strikes line up in a slightly different way relative to where the actual stock is, this might be a circumstance where someone might be slightly bullish on the actual underlying and want to trade the 85, 90, 95 call fly because of the fact that they have an idea that it's going up to 90. And remember, the most this can be worth is at 90, when that 85-90 call spread is worth the most that it can be worth, and the 90-95 call spread is worth the least that it can be worth. You're long this one, you're short this one. So that's the difference between what the condor looks like and what the butterfly looks like. The big difference here is that we're using 3 strikes versus 4 strikes. The butterfly has 3 strikes. The condor has 4 strikes. Let's talk a little bit about the broken wing butterfly and how that actual spread works, because it's slightly different from a risk perspective. Broken wing butterflies are generally the same structure, but one spread has a larger difference in strike prices than the other, generally. Now, what this necessitates is that it gives you a little bit of a different risk dynamic, because one spread, if you're trading one $5 spread against one $10 spread, you have the potential that one spread could be worth $5, but the other one could be worth $10. And if you're long one and short the other, you don't have a perfectly balanced risk dynamic. Now, you may have a closed-ended risk because of the fact that you are flat options net when you add up all 3 strikes, but you could have some wonky places in that P&L graph that are asymmetric as far as the way that the P&L plays out. Again, this risk dynamic changes the expiration P&L graph. Now, it can be adjusted through using different strikes and different premium amounts that are associated with those strikes, but the big difference here is the width of these spreads makes a huge difference in how the P&L looks. Let's take a look at the example, because this is what you end up with as far as the actual P&L graph is concerned. 88.5 with 28 days to expiration. We're back at the same place. Expected price range is 85 to 95. In this case, you're going to be buying the 85-90 call spread for 260, but you are selling the 90-100 call spread for 270. Big difference here. You're buying this spread, but you're actually receiving a credit for it. So what you're doing is you're putting this entire complex option strategy on for a net credit. But always keep in mind, there's no such thing as a free lunch, right? You can't get things for free without incurring commensurate risk for them, especially in the options world. I posted something on LinkedIn a couple of days ago that basically talked about a corporate action that could have been that someone potentially made a trade that looked like they were trying to buy something where they thought they might have been getting something for free. And what I said in my LinkedIn post was basically, listen, if you were trying to get something for free or you just didn't do your own research, both of these things can be avoided by just looking at the information memo page that we have on OCC's website. It tells you how all the options are being treated during corporate actions, and all of the information is great there. Go check that out. And if you haven't looked at it, I highly recommend that you look at it on a regular basis, especially if you're trading stock options. But the point of the matter is that I posted that, and then one of my friends posted something that said Tanstaffel, Tanafstal, which basically stands for there ain't no such thing as free lunch. And that's what this is all about right here. Broken wing butterflies are a very real example of how there's no such thing as a free lunch. You can't sell a spread that's twice as big as the spread that you're buying and have purely defined and balanced risk. You might have defined risk, but it's not going to be terribly balanced because the asymmetric nature of those spreads is going to come into play when you start to look at what the P&L looks like here. You're paying $260 for the 85.90, but you're selling the 9100 at $270. You've got this thing on for a net credit, but take a look at what it looks like on the max loss side. Why does this look like this? Because this spread, the 9100, can be worth $10. And if the stock goes up through 100, it's very likely that it's going to be worth $10 at expiration. But against that, what you have is this long 85.90 call spread. While it has theoretically expanded to its actual largest amount as far as its intrinsic value, it's still only going to be worth the difference in the strikes. So what you're left with is a $5 call spread that you're long that has expanded to the point where it's worth the most that it can be, but you're also left with a $10 call spread that you're short that is also expanded to the most that it can be, which is where you get this max loss of 990. Many people like to use these broken wing butterflies because of the fact that the difference in these strikes allows you to customize it in different ways as far as when you're thinking about whether the stock's going to rally or sell off, or you can customize it in ways that'll give you asymmetric P&L relative to the underlying movement. And that's always a great thing. And it's part of the optionality and part of the actual intrinsic kind of infinitely customizable qualities of options. But anytime people start to ask questions about complex strategies like this, my answers are always yes, and you need to always make sure that you have the headline risk on your radar as far as what is this thing going to look like if that asymmetric risk comes to bear. Because this broken wing butterfly, as you can tell, does not have the same risk dynamics as a 1-2-1 butterfly that are evenly spaced as far as the strikes are concerned. So make sure you pay close attention to that, especially if you're doing things like legging into broken wing butterflies or things of that nature. So I think we've covered a lot today. Ken, what do you think about some Q&A? You think we've got some questions that people want answered?
Hey, Matt, can you hear me? Yeah, I can. Yeah, great, perfect. So going through, there's a lot of questions coming in, and thank you again for that presentation. The first one I'm gonna bring up is somebody was asking, what is the difference between a condor and an iron condor? So I know the answer. I think you covered it in earlier on in your presentation, but essentially a condor is, or when you're talking about a condor or a butterfly, you're either using all calls or all puts. And with an iron condor or an iron butterfly, you're using either calls on one side and puts on another. So, and somebody was asking, oh, go ahead. Go ahead.
Ken, I would also add to that, and I said this a couple of times in the presentation, the iron condors use those out-of-the-money call spreads and put spreads. And really what you're dealing with is trading out-of-the-money options versus each other, which is completely different than what we talked about during this, creating that call condor, which has that in the money call spread as the bottom leg of it.
Right.
And that's important, especially in circumstances where you're talking about the potential of early exercise on an American style option, right? That's really what you need to think about there.
Right. And on the same lines, somebody was asking, well, why would I trade a condor versus an iron condor? And a lot of it is personal preference, but also in the case of a condor where you're using either all calls or all puts, think about if you're using an in-the-money call spread, depending on the spread of the options, it might be a little wider than you're used to. So if you're using the out-of-the-money call spread and the out-of-the-money put spread, the pricing might be a little more advantageous. So typically on in-the-money options, deeper options, sometimes the bid-ask spreads are a little wider. It might be a little harder to get into those positions. Any thoughts on that?
Yeah, I think that the interesting part about that is that it's also many times in the increasingly electronic trading environment that we're in now, many times a lot of these complex strategies are quoted as one price. You can get them quoted as one price on your screen. What you're talking about is certainly applicable, especially for people that are trading into these strategies by either buying the call spread and buying the put spread, those out of the money options, or selling both of them. And especially if they're doing them at different times, like they're legging into them, that can be a huge difference as far as the actual where you end up as far as price of the strategy is concerned. But it can also play into exactly what you said, which is if you're trading those spreads and crossing the bid-ask spread, theoretically, to trade both the call spread and the put spread, you're going to be crossing the bid-ask spread twice versus crossing the bid-ask spread once. So you need to think about that and build that into your strategy as well, as far as your execution price and or slippage that you would normally build in.
Right. And kind of a funny thing, and I remember even as a trader, I would get this, it would be kind of confusing, but in the case of, say, the long iron condor, even though you're paying a debit, and it's called a long condor because you're paying a net debit. You're long the call spread and you're short a call spread, and you're net paying an overall debit. But when you think about it, when you think about being long, if you're long a straddle, you want the stock to either go up or you want it to go down. If you're long a call spread, you want the stock to go up. If you're long a put spread, you want it to go down. When you're long a butterfly, long a condor, ideally you want that stock to finish at your short strikes or near your short strikes. So you really don't want stock to move unless, of course, you're buying something that's out of the money. An out of the money butterfly is a directional butterfly or a directional condor, which is something you can always do as well. But, it's kind of counterintuitive, like, the idea I'm paying a debit, but I want the stock to be kind of quiet or range bound. That was always something. Yeah, I agree. And something that sometimes people find counterintuitive. And to be honest, I kind of found it counterintuitive also when I first started trading these strategies way back when. Right.
But really what happens is you're paying a debit for this thing. And as long as the stock stays where you want it to stay, what ends up happening is the spread that you're long starts to expand and the spread that you're short starts to contract. And what you end up with is what I talked about, which is that wonderful point in the middle where you end up with the spread you're long being worth the most that it can be and the spread you're short being worth the least it can be. And that's really where the P&L comes from as far as the P&L of that strategy. As long as nothing ends up happening, it's really just you're dealing with the actual decay of the options and where they're decaying versus where they're not decaying, right? Like that's the important part.
Right, correct. Getting back to your point earlier when you're talking about the condor by itself, are you using an in-the-money call spread? Somebody was asking, isn't an assignment of the in-the-money leg a problem? And it can be, and this is where you have to understand why somebody might exercise on you early. And I know you mentioned before there are various reasons when you're using American style options. Obviously, anybody can exercise at any time. they wish, but there has to be this economic incentive to exercise, because by doing so, anybody who exercises a call early is essentially accelerating their expiration, and they would forego any time premium left in that option. So I know we've talked about in the past why somebody might exercise a call early. And typically, the reasons why somebody might exercise a call option early is for a dividend. I think you mentioned that in your presentation as well. So if the extrinsic value or the time premium portion of that option is less than the dividend, maybe you're short a in the money call. It's got 10 cents of time premium, but it's going to pay a 50-cent dividend tomorrow. In that situation, somebody's incentivized to exercise early, capture a 50-cent dividend, but at the same time, they're going to forego 10 cents. They're going to forego 10 cents in time premium to capture that 50-cent dividend. So you need to be aware of these things, especially if you're trading products that pay particularly large dividends, and know this ahead of time. Any thoughts on that?
Also, one additional thing that we should mention, which I didn't mention at all, but much of that risk that would be on your dashboard, as far as needing to look at that on a constant basis, if you're trading these call condors and you're doing them in something like an index like the SPX or something, where you're using European style options, all of that risk that we're talking about, the potential early exercise risk, goes out the window, right? Because European options don't maintain the potential to be exercised early. They're only actually exercisable at the moment of expiration. And so that part of the risk matrix that you might be thinking about would go away if you were using these strategies in a European style option.
Correct. Right. If you're trading SPX, you're trading Russell, you're trading NDX, things like that.
Yeah, anything that's European style, right?
Correct. So let me see here. Let's look at one more question. So somebody was also asking directionally, can I put on, instead of targeting the at the money or near the money strikes for my short options, can I put on an out of the money butterfly or an out of the money condor directionally? And yes, obviously you can do whatever you want. That's the beauty of options. Everybody has their own individual risk tolerance. Everybody has their own individual forecast. So you can design a position around just about any forecast you can come up with. And if you're somebody who thinks the stock might rally 10% and then just sit there for a week or two, you might put on an out of the money butterfly or an out of the money condor, and you're not going to pay very much for it. In the case of if it's just an out of the money butterfly or an out of the money condor, and because you're not going to pay very much for it, the likelihood of it actually going up 10% and sitting right your short strike is probably pretty small. But if that does happen, it has, it could have a huge payoff for you. So, once again, it's all about timing. It's all about forecast, risk tolerance, et cetera, et cetera.
Yeah, absolutely. I completely agree with that. I think we might be getting close to our time. Make sure, I did want to mention this last slide that's up here. Make sure that everyone takes a look at optionseducation.org, and really, I can't stress enough, options@theocc.com. This email address is something that it does get well used by people that know about it, but I think it could be a service that could be used so much more by people that need options questions answered. Again, Ken and Roma and I, along with another gentleman named Mark, sit on that desk and we answer questions that come in via email all the time. Please make sure that you lean on us, lean on our experience. We have, like I said, 100 years of combined options trading experience, and we utilize every single year of that to answer all of the questions that come in there. Options@theocc.com. Make sure you check that out. And then additionally, next month's OIC webinars are going to be featuring our fantastic instructor, Roma Colwell. She's going to be starting on August 9th and August 16th. Both of those are going to be about time spreads. Both of them are going to be about how options work relative to each other at different points on the duration curve. They're going to be great presentations, and you should make sure to check those out. You can register for those at optionseducation.org as well. Again, that's August 9th and August 16th. Those will be the 2 webinars coming up in August for OIC. All right, thanks for joining us today, everybody. Have a great day and enjoy the rest of your week.